Hi, this is Robert, and in this video, I'm going to talk about the fourth quarter of 2022 and also talk about the full year of 2022. So, as you know, it was a tough year all around for both stocks, bonds, real estate, pretty much every asset class, with one exception, and that would be energy. And I'll talk a little bit more about that a little bit later in the video. But for now, let's get a look at the fourth quarter. So the last 3 months of the year, you can see green across the board. So you have U.S. stock market was up about 7%. International did twice as well in the fourth quarter, up 16%. Emerging market and also real estate, all up somewhere in between the 7 to 10% range. We also had the bond market, which has struggled all year. It also was up in the fourth quarter. But now let's take a step back and look at the full year of 2022. And you can see it's a different story. So even with that outperformance in the fourth quarter, we still ended up the year down again across pretty much every single asset class. And as I talked about in previous videos, something was a little bit different in 2022. Typically, when you have the stock market not perform well, the bond market actually provides some stability and usually is a counterweight against the stock market. So you can see that for 2022, across the board, stocks performed very poorly. So you can see that the U.S. stock market down about 20%, international down a little bit less, about 15%, emerging market down 20%, and then real estate also down about 25%. So this was all for 2022. And as I previously said, typically what happens when the stock market doesn't perform well, bonds do. But 2022, different year, and we didn't get that same outperformance in bonds. In fact, we got significant underperformance in the bond market as well. So this is almost unprecedented. Normally, you do not see both stocks and bonds perform so poorly in the same year. And there are some reasons why we experienced that for 2022 that were pretty unique that I'll touch on in just a moment. But just know that across the board, almost any single investment or asset class investors were in 2022 performed very poorly. This is just a quick shot of last year, and you can see that where we started the year, where we ended the year, and then we just sampled some random headlines that made the news, both on the business front and outside of it, just to see how the market reacted. So we're big proponents of not trying to time the market, and oftentimes you'll see really negative headlines, and then you'll see very little response in the market. And so this is why you can't just sort of try to get in and get out of the market based on the news of the day. And this is why I like this page so much, because you can see some very negative headlines, and then sometimes there's absolutely no reaction whatsoever in terms of what the market does. On this slide, you can see going back from the 70s all the way to today, this is a longer term view of what the market has done. And you can see, especially in the pink here, these were times of very much difficulty in the markets. So we had the 70s, pretty much the entire decade, we had stagflation, which stagflation is rising inflation and a recession at the same time. Then we had the Black Monday crash. You could see that here in 1987. We had the tech crash that lasted a few years in the early 2000s. We had this drop, this precipitous drop here, the financial crisis of 2008, 2009. Again, very steep and quick drop with the COVID pandemic But look how quickly that retraced and made ground. Now we have what we're currently living in, and that is this 20+% drop in the market that we experienced in 2022. But if you look at the longer term view, you can see that we've experienced many dips over the years, and while we're going through it, it can be challenging. It can be very tough to sort of live through one of these drops of 20, 25, maybe even 30%. But if you expand your time horizon, you can see that over time, eventually the economy recovers and the market does recover. I really like this page because what it represents is these blue bars represent how the market performed in any given year. And if the blue bar is above this line here, then it provided a positive return for the year. And so, for example, in 2021, you can see that the market ended up the full year, up 29%. And you can see these little red dots. What that represents is that at some point during that year, the market, if you see a red dot, it means that it was negative. The market was negative for the year at some point, but eventually ended up positive for the year. So you can see here, one of the best examples of this is in 2020. So if you recall, March of 2020, we had COVID outbreak, and the markets dropped very quickly, just in a matter of a couple of weeks, dropped negative 34% in March of 2020. But it clawed its way back and actually ended up the year in 2020 positive 18%. So you can see lots of volatility throughout the year. What did last year look like, 2022? Well, we can see there was no blue bar above this line. That means that in 2022, as you know, the market ended with a negative return. At one point, however, the market was down over 24%. It managed to regain some of that ground. Most of that occurred in the fourth quarter, and it ended up down 18%, almost 19% for the year. Here's another example and sort of look at, you can look at this page as volatility in any given year. So again, each of these blue bars represents a given year. You can see that in 2022 was 12. What does 12 mean? Well, it represents the number of declines of 5% in that particular year. So the higher the bar, the more you can think of it as volatility in a given year. So 2021, very stable. 2020, that's again, COVID year, highly volatile. So we can see that there are high volatility years and low volatility years. And unfortunately, we can't predict what 2023 is going to be like. But what you'll often see is a few years of high volatility followed by several years of low volatility. So this is one of my favorite charts because what it represents is this dark blue line represents the S&P 500. So that is the return of the S&P 500 over many years, since 1990. So that's what the S&P 500 has done. Well, what is this shaded blue? What does that represent? Well, that represents the S&P 500 earnings per share. And what you can see is that there is often a correlation between what the stock market does in terms of the S&P 500 and what earnings are doing over that same time period. So you can see that as earnings go up, the market tends to go up. As earnings come down, the market tends to go down. And you can see here, earnings are going up, market is going up, etc. What do we have currently? Well, you can see that the S&P 500 is here, but earnings are up here. This represents a gap that at some point will close. So one of two things could happen. Either earnings per share will drop to meet where the market is, or the S&P 500, the market itself, will rise to meet the earnings. I guess there's a third option, and that is, of course, both of those things happening. Earnings could drop some, the S&P could rise some. But at some point, as we can see over decades, that the market tends to follow where earnings are. So right now, there is this fairly large discrepancy between where we think earnings will be and where the market is. The big fear in 2023 is not so much inflation. That was the fear in 2022. And you'll see here in a couple of slides what the Fed has done in raising interest rates to try to temper inflation. But the word on the street for 2023 is less about inflation and it's more about recession. With the recession, the economy slows down. And when the economy slows down, the earnings also slow down. And so this is why we see this big discrepancy right here, is because the market tends to think that these earnings expectations are too high, that they'll likely come down. And that's why you see this big gap here. So let's talk about interest rates, because in 2022, that was the story. At the end of 2021, rates were very low. Even in the early days of 2022, rates were exceptionally low here. In fact, you can see it right here, just very, very low. The gold or orange line, that represents the 2-year Treasury, and the darker blue line, that represents the 10-year Treasury. I think it's more important to focus on the 2-year Treasury at this point, because you can see it was virtually flat for several years. And then in early 2022, you saw this just exceptionally and rapid increase in the 2-year from basically nothing all the way up to a high of 4.24%. This move, unprecedented. The speed at which it occurred it has just never been seen before. And so the question is, well, why did this happen? Well, it's because of inflation. The Fed, and for many other reasons, didn't think there was going to be inflation in 2022. They called it transitory. They saw some at the end of 2021. They thought, well, this is going to go away. It's not a big deal. We don't need to do anything. Until they realized that inflation was here to stay. So they started raising interest rates very, very quickly. And because of that, because of interest rates going up so fast, there is now a fear that they may have done too much too soon. And their whole purpose in raising rates was to temper inflation. They want to see the economy slow down. That's exactly why they raised rates. Not only do they want to see the economy slow down, they want to see unemployment actually go up. They want to see wages come down. All of these things are an attempt to slow the rate of inflation, because you can see here that inflation rose quite dramatically. So where we are currently, and this is a page that looks at leading economic indicators. And so you'll notice a couple of things. One, you'll notice these blue bars up here. And then you'll also notice these orange lines down here. So what the blue bars represent are periods of a recession, and these lines represent leading economic indicators. When they're above this line, the leading economic indicators suggest that things are positive, that things are looking good, that there are reasons to be optimistic. When they turn negative by this orange bar, that means the leading economic indicators have flipped from being positive to being negative. And what that means is that the the economic indicators, it's trying to look out into the future, can flip from being positive to negative. And what we often see is when that happens, shortly thereafter, we see a recession. So you see it here, you see it flipped from positive to negative, this orange bar, and we had a recession. From positive to negative, and we had a recession. It happens time and time again. So where are we now? Well, we had positive economic indicators. That fell off a cliff, and now they've turned negative. We don't see a blue bar yet, but that is the expectation, is that we will have some form of a recession. The question is how deep will the recession be and for how long? As I mentioned earlier, part of what the Fed is trying to do with high interest rates is to temper the economy. And one way to do that is to have higher unemployment. What we see here is really very, very low unemployment figures. So while this is great for people, for getting work, for transitioning to new jobs, etc., it doesn't help the Fed's case, because the Fed is, again, trying to reduce the rate of inflation. And if unemployment is very, very low, it means that it's really hard to temper inflation. So what the Fed wants to see is unemployment go up. We haven't seen that yet, but if we start to, that'll be a positive sign, because that means the Fed can then not raise rates as much, or potentially even start to lower rates again. So that's something that we're looking at and following very, very closely, is unemployment and also wage growth. Both of those things are very important, because you can see right here, for years, for a decade, we've had low inflation. And inflation is measured here by the Consumer Price Index. Low inflation, the Fed's job was very easy. They didn't have to do hardly anything for many, many years, until late 2021. I'm going to say the fourth quarter of 2021, we saw inflation go up very, very quickly for many reasons. But now the Fed is trying to battle this very high inflation of 7.1%, which we haven't seen since the 1980s. So they've got some work on their hands, and they've done, I would say, a decent job in 2022 raising interest rates. Were they behind the eight ball? Did they raise probably too late? Absolutely. They were talking about transitory inflation at the end of 2021. They thought it was going to go away. It didn't. So then when they recognized that they made an error and that it wasn't transitory, they quickly started raising rates very dramatically. So the big fear now is that they've raised rates too much, too soon, too quickly, and now they're going to put us in a recession. As I said earlier, I don't think they would mind the economy being in a minor recession. I think that helps their case to lower inflation. But at the same time, if they've done too much, it's possible that they could drive the economy into a deeper recession, which I don't think they want. But that's the fear, that they're going to do too much. So lastly, you can see this page here, which I love. It goes back 2006 all the way to last year. And there's a lot of colors here. It can be very confusing to look at. But basically what it shows is each of these columns represents 1 year. And the colored blocks that you see represent the asset classes from better to worst performing for that particular year. So let's just, for example, look at 2018. So in 2018, the best performing asset class was fixed income. The worst performing asset class was EM, which stands for emerging markets, negative 14%. So every year you can see the best performing to the worst performing. And what you'll often find is that you'll see an asset class perform negatively for several years. So just look at commodities. So commodities, even going back several years in a row, they were some of the worst performing asset classes for years. And then you can see it became one of the best performing asset classes. And then it dropped back down to one of the worst performing. And here, commodities again, worst performing asset class. Now all of a sudden, it became one of the best performing in 2021. And it was the single best performing asset class in 2022. So often inexperienced investors will look at a particular year that just happened, and they'll say, oh, well, let's look at the S&P 500, for example. It was the best performing asset class in 2021, so it'll probably be the best performing asset class again. But look at what happened. It became one of the worst performing asset classes. So it doesn't make any sense to look back in order to predict the future. And so what we're constantly trying to do is look at the future. Doesn't matter what's already transpired. Doesn't matter what was the best performing asset class last year. What we're always looking at is what's it going to be going forward. And so that's why I just love this page, because you can see the volatility. You can't be an investor looking backwards, because often the best performing asset class becomes the worst performing, and vice versa. So if you have any questions at all about the markets in 2022 or what the outlook is for 2023, I would encourage you to reach out. Love to have a conversation with you. And so thank you again for watching the video. And again, if you have any questions whatsoever, please reach out. I would love to talk to you.